So I want to make this as easy to understand as possible. So we have stock options and we have sale of a home. I'm going to compare the two and make a little bit easier understanding of call options. So with the sale of a home, say you sell it for $400,000, you're going to go under contract, say it's 30, 50, 60 days, something along those lines. We'll say it's a 60-day closing. Now, to keep that contract where I have 60 days to get to closing, I'm going to give the owner basically 1% down. It could be more just if you want to get somebody to believe you're actually going to buy the house. You put $4,000 down. Whether you buy the house or you don't buy the house, guess what? The seller gets to keep the money. The buyer has the right to buy, but the seller has the obligation to sell if the buyer wants to buy. What do I mean by that? Well, if the seller walks away and they say all of a sudden, no, you're not selling the house, there could be legal ramifications where the buyer could sue the seller. But if the buyer backs out of this, they don't actually have to buy the house. They basically would give up that earnest money. What I want to do is talk about, what about stock options? How's this similar? Okay, so one options is about 100 shares. Don't get held up on that. We're going to take the SPY, the S&P 500 is about $480 a share right now. And we're going to say the strike price, we're going to call that at the money, meaning at the price that it currently is at $480 a share. Well, if I say I want to buy one option or the right to buy 100 shares in the future, which would be 60 days from today, similar to the closing, that's the contract expiration date, how much does that cost? Well, the premium here would be $11 a share times 100 shares is $1,100. That sounds pretty similar to over here. So if you look at here, we have earnest money, basically a premium for us to have the option to buy the home in about 60 days. So we take that 60 days and that's your contract term. How much would I be buying this if I actually bought it at $480 a share? Well, times 100 is $48,000. So that's the contract price. So you see how these are similar. Now again with this, the buyer has the right to buy the stock. The seller has the obligation to sell the stock. In the case of a house, the earnest money would go towards that $400,000 as partially a down payment. But in the case of premium on an options contract, that doesn't go towards the cost or towards the price per share. That's just the premium that the seller collects. So let's say 60 days out, we're now at closing. Let's say something happened to the house and it went down to $200,000 because there's a sinkhole or something bad happens. The buyer has the right to buy but not the obligation, so they end up not buying the house. If they don't buy the house, $4,000 goes right to the seller. They keep that for holding the house off the market for that period of time. The seller can then go and try to resell the house. They might not be able to sell it for more than $200,000 because there's another problem that came up. Now, let's say the market went up for houses and it went from $400,000 to $500,000. Then the buyer has the right to buy it at $400,000, but they know it's now worth $500,000, so they buy it and they could immediately turn around and sell this and basically net a $100,000 gain. We're not going to get into all the taxes and the 8% that you generally lose when you sell a house, but that's the kind of concept we have. Similar over here. So if we had a $480 a share contract and strike price at $480, and all of a sudden something happens and the stock goes down to $400 a share, basically you do not have to buy it. So you don't buy it. The cost or the premium of $11 a share, that's what the seller gets to keep. Now, if the stock went up and it goes to $500 a share, of course you're going to buy it because that's now much higher than the $480 a share. So you can either buy the shares or you could sell off the option to somebody else that will eventually buy it. So this is the big takeaway. If I bought the stock, I'm risking $48,000. In this instance, I would have lost $8,000. If I bought the option and took that loss, I will have only risked the premium I put up, that $11 a share or $1,100. So that's a very small risk, but I have unlimited upside potential. But just understand that over 90% of hedge fund managers which do this cannot beat the S&P 500. Statistically, the S&P 500 has outperformed anybody that's doing option trading. If you're looking to gain more financial education, I cover a lot of things that are stocks, bonds, how to invest, how to get out of debt, how to save money, how to buy a house, those sorts of things. If any of those interest you, please subscribe and have a great day.